Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with our Monday guest and somebody who has just an amazing playlist, Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. Good to see you.
Hey, I don't know if you saw it over the weekend or not. I think it actually came out Friday morning. It might have been Saturday morning. I forget. Anyways, Grant Cardone put out a really short video about, hey guys, the recession is here. It is bad. I think he was walking around Malibu and looking at nobody in the stores and the like. And the reason I want to talk about this with you is we have been very clear with folks. There are good times and there are bad times. We're leaving a good time and entering a bad time. It is not something to be scared about. It is something to see, appreciate, prepare for, but also, kind of like Grant was saying, get excited, because this is when assets go on sale. So is it fair to say, Greg, that you think a recession is either here or coming, and that we're leaving a good time, entering a bad time, and again, that people should be excited?
Yeah, definitely. We're definitely in one already. Again, that's just defined as negative growth for 2 consecutive quarters. We already had one. We're probably working on the second. And, the degree of that decline is, we'll just have to wait and see how that unfolds. But, you're starting to see the signs. You're seeing consumers pull back because of inflation. You're seeing companies start to lay off, but there's other companies hiring. You're seeing people leave the workforce. So that's kind of skewing things. So this recessionary environment's very different than anything we've ever experienced in the past. This is largely a Fed-driven, inflation-driven recession. So that's kind of where we're at. So it's a very different environment. Yeah, there will be opportunities, just like there always are in every recessionary environment.
Yeah, and again, people need to hear this, right? It's recessions are where real, I don't know, it's where you make your best deals, right? You find that motivated seller because you took your shot and you got a deal, right? There are just some people that in a recession, they need to raise cash, or they're near the end, they're done, they want to go do something else. And just, when I say assets, it doesn't have to be housing, right? I'm obviously a real estate investor, but it could be stocks, it could be crypto, it could be businesses, right? There will be deals all over. I think this recession will be 18 months to 2 years in duration. So the average, so just people know, is 17 and a half months. I think this one will be on the longer end because the Fed's just started to tighten. We haven't even really drained liquidity yet. So
yeah, and the markets haven't even, they're not even close to bottoming yet. And exactly, that's what excites me. So this is my third one. 2008-9 was the big one. Then March of 2020 was another big one. This is another one. And these are where you make big moves, and you ride that wave back up again. So there's a huge opportunity coming in stocks and crypto. You have to be careful because not all of them will bounce. Not all of them will rebound. You got to remember, a lot of the cryptos are going to just become obsolete. A lot of them are scams. A lot of them are just, people call them Ponzi's, and really what it is, a pyramid. It just takes more money to keep propping it up. So it takes new money, to increase the price, and then eventually you run out of investors and thing collapses. So that's what a pyramid is. Ponzi's, taking money from one investor to pay another. Crypto is not really a Ponzi, although there's a couple that are borderline on that with these algorithmic stable coins that are out there right now, and using that, printing coins to buy Bitcoin and stuff like that. Anyways, that's a whole nother topic. And, Bitcoin's a store of value, but some of the altcoins will go away. Bitcoin will not go away. It will not go to zero, but it'll go down. And we've seen where those bottoms are. It's around $4,000 in the worst case scenario that it has dropped to. So if everything just, tanks and we get a huge market crash, that's probably where Bitcoin will bottom. And that's where it bottomed last time in March of 2020. It's where it bottomed in 2018 before that, at the bottom of the bear market. And you can see where the markets bottomed before the Fed intervened. So here's your signal of the day. How do you know when to get in the market? How do you know when to get out of the market? Listen to the Fed. They tell you. They told us when to get out.
They did.
Back in December, when they said we're going to tighten. Yeah. And they, will tell us when to get back in when they say we're going to loosen. So
yeah,
all you got to do.
Yeah, it is. So again, it's funny. This is really my fourth bear market, and the first one. So we're about the same age, right? The first one got me. I was over my skis. I'd gotten too cocky. I got too leveraged. I was playing in non-profitable stocks, and I suffered the consequences. Since then, the next three that you've talked to, this will be my third one as well. You can see them coming once you lift your head up and you realize that, the Fed is your friend or the Fed's your enemy. There's some pretty clear signals. So it's funny. We've been talking about this. We've been telling people to prepare. You can go back and watch your playlist probably for the last 6 months. Like, it's coming, right? You can't have 8.5% CPI and the Fed doesn't tighten, right? It's coming.
Yeah. And this is a global thing this time. And, countries around the world are having problems with inflation. Again, it's mainly an inflationary driven environment right now that's going on, and monetary policy is huge, but it's happening all around the world. So for me, I'm looking back at recessionary environments. So the first one that I really experienced, I was in high school in the 80s when that one happened, 80, 82. So 90, 91, I got married in 1990, bought my first house. And it was a very tough time back then in the real estate market. Interest rates were high, builders were having trouble selling houses, or, it was a very, very difficult time. And then of course we had the 2001 recession, then we have 2008 and 9. So I've been through, 4 of them in my lifetime, but none of them, again, were quite like this. And this one, everybody's experiencing the same thing around the world. All of the central banks around the world are hiking rates. They're cutting back on QE. Everybody's having to tighten monetary policy because it's a global thing, and we've got to cool down, all of this heated inflation around the world, which is the only way to do that is a recession.
Yeah, you've got to have demand destruction. Just the demand. I think we're on the cusp of real demand destruction. You're seeing it already in housing, right? Real estate. People that qualified at 3 don't qualify at 5.5. It's demand destruction. But it's also going to have unintended consequences. I think the other things that's going to happen is the Fed reduces its balance sheet. Is we might have a liquidity crisis. The problem with liquidity, it's like water, right? You just don't know where it's going to go when it kind of gets on the floor, right? So,
well, that's the thing. So the Fed has to break something. So markets, banks, and that's done through liquidity, credit markets, and that's when, that's where a seismic crack in the economy that's systemic, like the banking failure 2008-9. Right now, there's a very different environment because the banks are relatively healthy, unless credit markets have a problem. If and they're already starting to, have issues here and there, but if credit tightens and freezes and that starts to crack, that's a systemic thing that'll send shockwaves around the world. Then you end up with a 2008-9, event, which was largely, if you take housing out of the equation, was largely a market event. But again, liquidity affects housing. So if there's no money buying those mortgages and being thrown out there at the, lending environment, lending tightens, you start to get credit controls, which are more stringent requirements to get a loan, more expensive, more difficult to qualify, bigger down payments, things like that. So those are the types of things you face in an environment where liquidity is tough and the credit markets start to crack. Businesses can't borrow money. There's a lot of different things out there. And, again, we're seeing it. We're seeing, especially in the VC world, VCs are laying off. A lot of the startups are laying off because they can't get the money anymore. And they're not, companies that are negative earning, and have more burn than revenue. They're having to lay off people because they're not able to get the money. So you're already starting to see the cracks show up.
Yeah, I saw that actually. It's funny. I brought it up on the daily financial news. I think it was last Friday. That debate. From the first time I saw, because I'm in the Valley, right? I have a feed which is very Valley focused, and there was a lot of people saying that tech's already started to lay off. You're absolutely right. It's all about burn rate. You went out and raised at some number. You got a certain amount of money in the bank. You have overhead. You are not making money. You're losing less money, but still losing. So people are going to calculate their burn rate, and it's about extending, because this could be a 2-year recession and you've got to survive, right? So if you come out the other side, you'll be stronger with less competition. But yeah, there are a lot of companies today that get sold on revenue that are just money losing dogs, and they'll go
Here's
to
the
zero.
thing. So markets are always forward looking, and markets are repricing and readjusting. Why is that? Because the Fed really hasn't done anything other than 75 basis points now between the last 2 rate hikes. So we're still, what is the Fed funds rate? Yeah, we're still not even at 1%.
No, well, we're not.
So we're still basically, interest free, zero interest rate environment.
We have negative rates today. Negative rates, really? If you do the math.
Just stopped buying. They were buying mortgage-backed securities all the way up to the end of, I guess, through Q1, right? So they just stopped that. So that is a fundamental change. But the reason the markets are doing what they're doing is because of the earnings and the companies coming out saying, lowering forward guidance, reducing expectations, into 2023. And they're saying, look, we're not going to see revenues and sales and profits in 2020, the latter half of this year going into 2023, like we saw, after opening up from the pandemic. So it's really interesting. That's why the markets are doing what they're doing, because companies are coming out saying, look, we're cutting, staff, we're cutting back, and they're lowering, their revenue expectations and guidance. And, markets are reacting to that. So the next leg down is when the effects of that start to happen. So right now they're saying this is what's coming. So when it comes, that's when the next leg down is in the market. So that's kind of what's going on. It doesn't drop overnight. It can, but it's going to take some time to work its way down. I think we're going to be at, some pretty low levels here by the end of the year.
Yeah. At the end, when kind of wrapping this up, kind of like Grant Cardone did, you're more excited. Well, I don't want to put words in your mouth. I'll say mine. I'm more excited to create deals this year than I was last year or the year before. It was just too hard. It was easy money. The next 2 years is not easy money, which means the professionals, the people that do the work, should be excited. So I'm excited for the next 2 years. How about yourself?
Yeah, absolutely. I mean, there's always opportunities and very different environments. So people that think Great Depression, things like that, I mean, that's just not possible in this, current global climate that we're in, barring nuclear war or something like that. I mean, then that's a possibility if that breaks out, that could destroy economies around the world and put you in a depression.
Yeah.
But, as far as general operating procedures and, relative, security around the world, I don't think you'll see depressionary environment, but you can see deep recessions. And, the deeper it goes, the more opportunities there are if you've preserved capital, which is what we've been talking about since, the end of last year, where a lot of people say, oh, you're just a couple of bears. No.
Oh,
this is preservation of capital. This is managing risk so that you have the capital to take advantage of the upswing when it comes around.
That's what I hope people hear from this. Because again, the beauty of all our videos and your playlist specifically is you can go back and listen to several hours. Now that we have a long history, you can go back and see where we've been. We are not bears. We are both people who say bet on America, right? Bet on capitalism, bet on all these things. We just have the business cycle. We are leaving summer and going to winter. It happens. I'm more excited now that it's going to be winter than in summer, because I'm willing to prepare. I'm willing to be early. So thank you for all you do, Greg. Where can people find you?
Yeah, gregdickerson.com. That's where my info is. Go check it out.
Thank you, buddy.